What is up, everybody? Before you guys go ahead and watch this next module, if you want to watch me and the team trade live for absolutely free for 7 days, as well as get access to everything that we have within the Learn the Markets Discord community, go ahead and check out the 7-day free trial. If you're not already in the Discord, I will attach a link at the description of this video so you can go ahead and check that out.
What is good, everybody? Welcome back to another LTM crash course module. Today we have module number 6, and it is going to be the last technical concept that we are going to be covering for this crash course. Today we're going to be discussing key areas of retracement. Now let's first dive into what are key areas of retracement. All that we are referring to when we say key areas of retracements is essentially these are areas where we're going to be looking for price to pull back into for us to actually to be able to take an entry. Now, more importantly, because these are retracements, right, and not a break of structure, we're essentially looking for a continuation of that trend. Hence, these areas of retracements are essentially going to be continuation confluence. Now, the two main tools that we're actually going to use as areas of retracements for us to actually be able to take trades from are going to be fair value gaps and inverse fair value gaps. And the whole reason why these are actually relevant to us, like why they're actually important, why are we even using them in the first place, is because the market will actually seek to do one of two things. All right. We already covered liquidity, and we mentioned that one of the first initial principles around liquidity is that the market price, right, will seek out and gravitate towards these areas of liquidity. So the market, we know, seeks areas of liquidity. Now, the second thing which we are introducing is the market will also seek to rebalance inefficiencies. And that is all just a fancy way of simply saying that the market will, one, seek areas of liquidity and will then seek to rebalance fair value gaps, because fair value gaps are supposed to be imbalances, which are inefficiencies. So those are all interchangeable terms. Whether you want to call them inefficiencies, imbalances, fair value gaps, it doesn't really matter, but they all mean the same thing. Okay, now let's actually dive into how to actually visualize fair value gaps. First, we're going to go over FVGs, and then towards the end, we'll dive into IFVGs, and we'll obviously give you guys some examples with actual price action. Now, just establishing how to actually draw and visualize fair value gaps, starting with a bullish fair value gap, they're going to be essentially a 3 candlestick pattern, all fair value gaps, right? It's a 3 candlestick pattern where in a bullish case, the first candle's top wick is not going to meet with the third candle's bottom wick. There's going to be a space between the first candle's top wick and the third candle bottom wick. This range right here that we see unfilled, that is our imbalance. That is our fair value gap. And the reasoning behind this is that what we see is between these 3 candles, right, we have price moving up, and this second candle is able to continue, right, towards the upside with an aggressive momentum, showing you that there's a lack of sell orders through that space that it was able to move in that was created between the first candle's top wick and the third candle's bottom wick. That's all it really is, right? There's essentially, in this case, for the bullish case, there's a lack of sell orders in this range, and price is likely to come back, rebalance that area before continuing to the upside. That's why it's a continuation confluence. We're looking for price to pull back into these areas and then continue the underlying trend. So if we were to actually draw it, in this case, this bullish fair value gap, top wick of the first candle, bottom wick of the third candle. That's essentially a bullish FVG. Now, for a bearish FVG, the principle is going to be the same in terms of drawing it, just flipped, right? You're going to have the first candle's bottom wick, and there's going to be a space between the third candle's top wick and the first candle's bottom wick. That is going to be your bearish FVG. And the conceptual is going to be essentially the same, just flipped, right? We essentially had this second candle that was able to move efficiently with speed and momentum to the downside, showcasing that there is a lack of buy orders from that space between the bottom wick of the first candle and the top wick of the third candle, meaning price action is likely to come back, rebalance that inefficiency, and then continue to the downside, okay? That's it. That's essentially how we're going to actually go about drawing FVGs, all right? But I'm going to cover not only some actual examples, but more importantly, how to actually go about filtering this, because this is extremely key, because it's such a simple concept and confluence to use that you're going to see it a lot. So how are you actually going to be able to filter quality fair value gaps from what wouldn't be, quality fair value gaps, some that you shouldn't actually be taking into account? And the key for that is going to be context, context, context. What is price action actually doing to the left and relative to everything that is happening, and how is that fair value gap getting created? Okay, and I'm going to dive into that with actual visual examples. So let's go ahead and actually take a look. All right, so we're now on ES on the daily time frame, and I'm essentially just going to be pointing out some fair value gaps, and more importantly, giving you guys my thought process as to how I'm actually analyzing the fair value gap that's getting created. What is the context around it? Is it a quality fair value gap? Is it, a shit fair value gap? Why would I not take it into account? And that sort of thing, because that's the most important thing. As I mentioned previously, this is such an easy concept to understand that it can get misused or overused under the wrong context, right? And that's the overall importance here. You guys have to understand that, yes, you can understand the concept, but it's actually knowing when to apply it and how to apply it, under what market conditions, under what circumstances, what are the signatures that you're actually seeing on price action playing out and materializing that allows you to take note that, okay, yeah, this is going to be a quality fair value gap that we can pull back into. I can go ahead and potentially take a trade from that before a continuation. All right. So we're on the daily time frame, and there's already one that I see. So context, 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 right? We have 1, 2, 3, 4, 5, 6 green candles right here, right, that we see. But the 3 that I'm taking note of are these 3 right here. Why? Because this is essentially 3 candles of the leg that was able to break above this previous lower high, this previous lower high, above all these previous lower highs, lower high, and then these previous highs, and was able to then reestablish momentum to the upside. And after that, as we can see, hindsight is always going to be 2020, but it gives me the opportunity in this case to showcase the context actually playing out, right? So if we were to go ahead and draw our bullish fair value gap from here to here, there's a couple of things that I personally am not a huge fan of this fair value gap, right? As we can see, it does end up working out beautifully, right? We have the move, price pulls back into it, we respect it, we actually come down to the 50% mark of the fair value gap. We call that consequent encroachment. It doesn't, once again, fancy word, doesn't fucking matter. 50% mark, halfway to the fair value gap, we respect it, and then we actually trade out of it with some nice momentum with these series of green candles to the upside, right? Now, it does work. Hindsight 2020. We will always wait to see how is price actually reacting at these fair value gaps, especially at these higher time frames ones, right? That's a super, super important. You can't just, once again, just like liquidity, you can't just take a trade because, oh, we swept this high, we swept this low. You need to stack these confluences together. It's the same thing here. You shouldn't just be taking a trade blindly because, oh, we tapped into an FEG. So in this case, we tap into it. We can see we respected it. But this is a massive, massive range of price. This is 126, 127, 125 points essentially on ES. That is huge, okay? But relative, once again, to the candles that are being printed, these are also massive candles that we're seeing on the daily. This candle in and of itself, right? If we go ahead and measure it, these candles, this is a 88-point candle. This right here, 100-point candle in and of itself right here. Another 60 points. So these are massive, massive candles. So relative to the candles that are being printed around it, yes, it makes sense that we ended up respecting it. Also, we didn't dip too low into it. We ended up respecting it. We filled it and then traded out of it. Okay. So it did work in this case, but this is the thought process once again that I'm going through. What are the candles that are being printed around it? How big are they relative to the fair value gap? Is it making sense? Is it okay? We have an FEG. This is a very small one. This is a good example. Once again, right? This is a very, very small FEG. Even though it gets respected, as we could see right here with this wick, we end up filling it and then trading out of it. We would invalidate it if, for example, in this case, the candle would have closed below. If a candle closes below, in this case of a bullish fair value gap, it gets invalidated. But we can see here that we do respect it. But why is this not the most quality FEG? Because one, is there context? First of all, we have this leg to the upside that is able to take out these lower highs, and this high. So there's a context. We establish momentum to the upside, right? But this is such a small range relative to the candles that are being printed around it. This is 7 points relative to a candle that was 55 points, 70 points. So you get what I'm saying? Now we end up respecting it, but in this case, this is somewhere where I would potentially drop on the 4 hour or on the 1 hour, excuse me, and see is there another more quality fair value gap relative to the candles that are being printed around it. But the context on this one is there, right? We have the continuation leg to the upside. We break the lower highs and these highs. We come down, respect it. But not only do we respect it, but what happens after? Even though we respect it, we trade up, we create a lower high, and then we end up dipping below it. Okay. Now, I'm trying to see like what's a great example of like an easy quality. For example, all right, this one just stuck out, so it's really easy to see. This is beautiful. This is beautiful, beautiful. This is a leg to the upside that breaks past the previous higher high that was printed. After we took out liquidity here, we then started reversing to the upside. Higher lows were being printed, higher highs. And this was the continuation leg to the upside. We had a series of beautifully printed up close candles, continuing the momentum to the upside. And then we have that FVG that gets made right here. And relative, once again, the size of this fair value gap is right in line, 34 points with some of these candles. This is great. This is great. These candles are also big, healthy candles to the upside. And what do we see? Price action trades into it, respects it, and then we fill it, and then continue to the upside. And then we actually have another subsequent fair value gap right here. We have one here and right there. And once again, relative to the candles that are being printed, these candles are small, right? This is a solid FEG as well. What do? We dip into it, respect it, trade out of it. Where's the context here? Well, this was the continuation beyond this previous higher high. So we continued the bullish momentum that we had seen after we swept the sell side right here. You guys are able to see, once again, the context. Even if we continue right here, we have a fair value gap, we dip into it, we try to trade out of it. We do trade out of it, but we end up sweeping these highs, right? After we sweep those highs, we can see we had already filled it so that you wouldn't really need to have it on your charts at that point. I personally, once a fair value gap gets filled, I take it out, and then we trade to the downside. Let's point out some other examples. So this is a good example, right? Even though we reject it, right? So you could have potentially taken a short if you would have set something up correctly, right? We're not just taking blind trades just because we tapped into an FEG. But hindsight 2020, we can see it ends up working out beautifully. We trade pretty high into it. This candle, this is very important, right? Because we didn't invalidate it because this candle ended up closing below the fair value gap, respecting it, and then boom. Nice little dump out of that. But what happens here? What is the context? Continuation leg after we broke structure to the downside and a lower high was printed. This was a continuation leg to the downside, an absolutely massive one at that, right? We do end up respecting it, but we end up also respecting this higher low that got printed after the sweep of sell side, which we had covered earlier in one of these examples. So we end up actually printing a higher low and then end up actually pushing to the upside. So it did actually momentarily work out. For example, if we were to just go ahead and replay that, like this could still be a lower high being printed on the daily. Like this was still a lower high being printed. So at that time, context was there. It ended up working out. We had solid reactions out of it. So it did work out. But obviously, in hindsight, we can see that it ended up getting, that at this point, price action was actually establishing structure back up to the upside. So we can go ahead and exit bar replay. I'll do one more example. This is like we do have here one. Oh, why don't I like this? Massive FEG in comparison to the candles that are getting printed. This is a beautiful candle follow through, but we do end up respecting it in hindsight. But this is an area, once again, where I would zoom in into like the 4 hour and 1 hour and see if there's a better quality fair value gap. We do end up respecting. So for example, once again, if we were to replay price action, we had the continuation leg of bullish momentum. We put in new higher highs. We dip into the fair value gap, and we do see that we fill it because we trade out of it and close out of it. So at this point, it did end up working out. But what do we end up seeing is that we actually failed, right, to actually continue past the previous original high that we had put in. We actually end up sweeping it, and we can see that after that sweep, you guys can see how we're starting to put things together. We end up actually getting a break of structure after we break below this higher low. So at this point, this should be becoming very apparent. Once again, it's an easy concept, but just because it's easy doesn't mean you should be fucking blindly drawing fair value gaps. Okay, your chart shouldn't be like a Picasso drawing. Just to be clear, all right. Make sure you guys are actually putting context and thoughts into the fair value gaps that you're drawing, just like I did. What's the narrative? What's the actual move that is happening? Looking to the left. What's the context relative to structure, trend? All of these things that you guys have learned. All right. And now we're going to wrap it up with IFVGs. All right, let's actually talk about IFVGs. Now, IFVGs are simple to understand as well, right? It's essentially in the name, kind of self-explanatory. They're inverse fair value gaps. So they're essentially FVGs that are you're looking to essentially get invalidated as an extra layer of confluence, right, and confirmation that you can then also use for price action to retest, retrace back into to go ahead and take a continuation entry from. Now we're on the lower time frames here because it gives me the opportunity to actually showcase how, in line with more how we're actually going to use it when it comes to time to take a trade, as opposed to doing it on the higher time frames. Because with IFVGs and even fair value gaps, right, you can use them in the higher time frames to start building context and a narrative for yourself to see how price is reacting at these areas relative to overall structure. But when it comes time to actually take an entry, it's slightly different, right? It's the same concepts, same principles, but you're not doing it on a smaller time frame, right? So even then, there has to be more emphasis on what you're actually paying attention to. So this right here is going to be a perfect example of actually showcasing an IFVG, right? So an IFVG, once again, is a fair value gap that you're looking to get invalidated. And what is the actual context that we see here in this fair value gap right here? This was a bearish 5-minute fair value gap. We're on the 5-minute, right? What is the context here? We had dipped, we had broken structure to the downside, and we're now dropping. A lot of people are going to look at this, take an entry here. They see these rejections. They're like, oh my God, we're going to go short. We do end up filling it. We trade out of it. But what do we also do? At this point, we're printing a higher low, even though we rejected it. Why? Because we had now broken structure back up to the upside after printing a relative external higher low. Why? Because if we look at the previous external higher low, right, this was getting respected. Not only that, this is where higher time frame is also extremely important. Let's look at the 15-minute. What is the 15-minute doing? Dude. Yeah, we had a massive drizzy fucking news candle, but this is looking bullish, right? This is looking bullish. We broke structure on the 1 hour. We broke structure on the 4 hour. We broke structure on the 15-minute, all to the upside. And on the 5-minute, even though, yeah, we momentarily broke internal structure to the downside, like the higher time frames are all pointing bullish anyways, and we still respected the previous external higher low on the 5-minute. So if you were looking to actually take a long in this case, right, because you're being able to take note of all of these things, and you're essentially taking this as a potential manipulation or a fake move to the downside, because if we look at the 15-minute, even though we broke structure, on the 15-minute, we respect it. On the 15, we print a higher low. This one gets respected because price trades up, price does this, and then trades higher. So this low right here ends up getting respected. And even if we take it to the 30, for example, higher low, man, higher time frame. The higher time frames, even the higher intraday time frames, they're all pointing at a higher low being printed. So even though the 5 is breaking structure to the downside, all the other time frames are telling you the complete opposite. So in that case, if you want to use this, an IFVG, as a confluence, you want to see this bearish fair value gap get invalidated, and you want to use it as a confluence to then go bullish, right? What we see is even though we get these rejections, we already covered, higher low, we trade out of it. The minute you trade out of it and you invalidate it, that it becomes an IFVG. I like to change them and template them purple. And what we can see is we can also see the concept of once these IFVGs get invalidated, right, with the proper context, you can actually use them as well as a continuation confluence where price can retrace, where you can go ahead and take an entry from there. So what do we see here? This is a beautiful, beautiful, beautiful example. Higher low gets printed, invalidates the fair value gap. We print another subsequent higher low and tap into it. We retrace, tap into it. This is now looking bullish. This is now looking like a bullish trend on the 5-minute, which aligns with the higher time frame narrative and the narrative that we're seeing on the 15 and 30. So this aligns with everything. And that's the goal, right? Aligning our smaller time frames with the narrative on the higher time frame. So how would I have potentially taken a trade here? After I already see, right, my break of structures to the upside, we invalidated the IFVG right here. We retrace into it. we can go ahead, hop on the 1 minute. And what we can do is, let's say you wanted to take an initial entry here, which you could, right? You could. You place your stop below the previous swing low. Your confirmation on the 1 minute, for example, is going to be a break of structure that aligns then back up to the upside. Because the 5 minute here, our bet here is that the 5 minute is printing a higher low, right? Even though the 1 minute is going to look bearish, right? A retrace on a smaller time frame is going to look like a reversal, like your breaking structure, right? That's why having the higher time frame is key. And then, for example, once you're able to trade out of that, if you wanted to add or then take your trade, it really depends on you and how you actually go about with your strategy. You can go ahead, then move your stop to the previous swing low and that continuation, and your target could simply be that previous high in this case. And let's see if we actually end up hitting it or not. Let's see. Do we hit TP? Yes, we do. So you guys can see right there how just by using this, layering it with market structure, right, we were able to catch almost, nice 10 points on ES. This is an IFVG, and this is a perfect example of how you would actually go about incorporating it into your trading. All right, guys, that wraps it up for module 6. We have covered key areas of retracement. We are done with the technical concepts, peeps. I hope you guys have been going through the content diligently, taking notes. This is all absolutely free game that I'm dropping on you guys. Absolutely free. Take it, do what you will with it. But this is free sauce, guys. And I tried, specifically in this video, I try to be so critical in terms of actually telling you guys, how do we actually go about implementing this and filtering it? Because some of these concepts are so important, which is why context is so incredibly important. And I talk about it time and time again. With that being said, stay safe, stay blessed. Peace, guys.